Welcome everyone, thanks for joining. Every once in a while, as I'm browsing the internet and spending my time on the Discord, the community Patreon Discord, and amongst different internet investing forums, I come across a piece of content that is really good, one that changes my perspective, one that makes me think differently about a topic, and it molds my views on different subjects. When a piece of content like that comes around, it's rare. And when I find something like that, I have the urge to share it with you. I want to just take it and show you what I found. That's what I want to do in this video. I came across this article here from the author Qin Hui Liang, Chinese name, so I probably butchered it, but I think that's his name. And it's been shared on the Discord, it's been shared around Twitter, it's making the circles, and I think for good reason. I think that this is a fantastic write-up. The subject of it, as the title says here, is buying a good stock is easy, but can you hold? Now, normally this is paywalled, but the author here was kind enough to share this screenshot of it. So I want to go ahead and just go through it because I really think this is worth the time. It really changes my perspective on a few different subjects here. So he starts off with a story saying, imagine this, you bought a stock for $3.30 per share in January of 2007. 5 years later, the stock price almost soared to $10. How would you feel about this investment? Putting it in perspective, the gain would be more than 200% or an impressive 25% per year over this period. That return would put a smile on any investor's face. And that's not all. During this time, the S&P 500 benchmark for the US stock market lost almost 13% of its value. So you not only beat the market, you also crushed it. Wouldn't you be thrilled with such amazing returns? I would when I read this. If I went from $3.30 per share up to $10 per share, especially during a time period where the market was going down overall, you'd have to be satisfied with that. I think you'd be pretty happy. But then we get into it. He highlights the treacherous journey of big returns. He says, I haven't told you the whole story yet. I gave you only the start, the purchase price, and then the end, the price 5 years later. What happened in between was a wild ride. This stock went from $3.30 per share to over $42, and then it crashed back down to under $10. That's insane, right? But how do you feel about the investment now? You may not feel as good as before. Maybe you wish you had sold your shares when it was $42 per share. Now that may sound like a smart move, but if you had sold the stock at this peak, you would have still missed out on a fortune. So all of a sudden things become more complicated. Instead of going from $3.30 to $10 and getting a nice 200% return, which instantly in my mind, I visualize that as a granular gain, just a gradual linear gain over time. $3.30 going a little bit of volatility up to $10. But the story that he shares here instead is one of going from $3.30 to $42 per share, then back down to $10 per share. A lot more emotionally tasking. This is the type of thing that plays with your decision making, your judgment, and your emotions. It's a lot more confusing. He continues on here saying, leaving money on the table. The stock I'm talking about is Netflix, which I have held since January of 2007. Today it's worth over $442 per share. That means that if you had sold at $42, you would have given up another 10 times your money. Even if you had bought at $42, you would still enjoy a huge profit. Here's what I want you to understand. Netflix stock price history shows you how hard it is to buy and hold a stock, even when it turns out to be a big winner. In theory, it sounds easy to buy a stock and to do nothing. But in reality, many investors lose their nerve and sell too soon, before the stock reaches its full potential. That is a painful mistake, because you miss out on the chance to make huge gains on your investment. It's like having a winning lottery ticket in your hands and throwing it away. So to summarize so far, this guy has held Netflix stock since January of 2007. And in that time, he's highlighting the journey that the stock has gone through, going from $3.30 to $42, then back to under $10, then up to $443. All these peaks and valleys in between that he says scares people out of stocks. Now, this next part I think is particularly helpful because not only is he talking about the problem, but he's also talking about his solution, what he thinks investors can do to not sell out of good companies like this, what he did to keep in Netflix this entire time when most investors sold out. He says big money in the holding. Charlie Munger, vice chair of Berkshire Hathaway, once said that big money is not made in buying or selling, but in the waiting. He is right, of course, but holding a stock is hard. Along the way, doubts creep in, and investors end up sabotaging themselves by selling too soon. As the Netflix stock soared to $42, investors may be tempted to cash in. On the flip side, as the stock plunged to $10, some will panic sell out of fear of losing more. This is why it's critical to learn how to hold a winning stock. I want to share with you 3 principles to help you overcome these doubts. So we list out the reason and we get to number 1 here. And this is where it really gets important because he's listing out the reasons that we should stay invested in our bets, that we shouldn't get discouraged and give up on them. Don't fall into hate with your stock. It's a little bit jarring to read. It's different than the normal phrase. He says, every investor knows you shouldn't fall in love with your stocks. I would suggest you do the opposite too. Do not fall into hate with your stocks. The hardest part to endure is a stock decline. Most investors will start looking for reasons for a decline as they dig for answers. They often focus on the problems and ignore the positives. That is so true. Anytime a stock goes down, everyone stops looking at any positives and they start looking at all the negatives. Look at Dollar General or Paramount or Disney or PayPal. If these stocks were racing upwards, people would be looking at the positives. But because they're racing downwards, everybody's highlighting the negatives. Now, the example he gives here is again Netflix. He says Netflix is a great case study again. A year ago, the online streaming platform recorded a loss of more than 1 million subscribers in the first half of 2022. That was a brutal year for Netflix. I was in that stock heavy. I went through a 70% drawdown in the stock. It was emotionally tasking and brutal to go through. He says many reasons were cited, ranging from the crowded field of competitors to the lack of quality content. In the process, investors overlooked the positives. Netflix had a strategy in place to launch an ad-supported plan while cracking down on password sharing. Within 6 months, it launched a new ad-supported option, surpassing all expectations. Since then, it's added over 15 million subscribers, more than 15 times the number lost in 2022's first half. Isn't that incredible? Everybody was all doom and gloom with Netflix. Oh no, Disney Plus and all these competitors are going to crush Netflix and they're losing subscribers, they're shrinking. This year, they've added 15 million subscribers, which is 15 times what they lost last year. See what positivity can do and staying optimistic with the stock? Those who sold in fear would have missed out on a 170% gain from its 2022 low. So the investors like Bill Ackman that sold out of the stock and gave up on the narrative of it, the thesis of it, they missed out on a massive recovery. Then he says number 2, beware of false narratives. The financial media loves pitting one competitor against another, painted as an epic battle. There is an underlying narrative suggesting that one can only be victorious. In other words, for one to succeed, the other must fail. In the case of Netflix, Disney Plus is often portrayed as its rival. But here's the truth. There are plenty of examples of 2 major competitors thriving in the same market. Take MasterCard and Visa in the payment processing space, or Alphabet and Meta for the digital ad space, or Coca-Cola and Pepsi, who have been competing since the 1980s. All of these companies thrive despite the presence of another competitor. So the narrative that the media likes to portray, that one of these companies has to duke it out, they're king of the hill and everyone else loses, he's saying that these are a false narrative to drive media clicks and YouTube clicks, but it's not necessarily the truth. Of course, there's enough people, enough eyeballs, enough people that are going to pay for both Netflix and Disney Plus. Lots of families have both of them. So while the popular narrative suggests there can only be one winner, there are many cases where this narrative simply does not hold up. Number 3, better to hold a losing stock too long than sell a winning one too early. Cynics will point out that most stocks are not worth holding for the long term. They are right. There will be times where you buy a stock, hold it for 5 years, and end up with little to nothing to show for it. Or worse, you may even lose money. But let me show you the other side of the story. I sold half of my original Netflix holding along the way. By doing so, I estimate that I missed out on 6,200% gains for the shares sold. So he sold a bunch of his Netflix along the way, he took some gains, and that turned out to be a massive mistake. Regret doesn't even begin to describe my feelings. It's like holding 62 stocks that went bust, and the chances of finding another Netflix are slim. So another way of phrasing this is he could have literally bought 62 stocks that all went nowhere if he would have just held on to his Netflix. It would have made up for 62 different investments that went nowhere. So even though most stocks fail, the ones that you hold on to that win can make up for all of them. And this is a point that Peter Lynch repeatedly made. He said that you only need 4 out of 10 stocks to do well, or even less if the ones that do well do really well. And oftentimes, if you buy a great growth stock, it'll keep growing. With Peter Lynch, it was Dunkin' Donuts and Home Depot and Toys R Us. With this author, the stock is Netflix. He says, this experience fuels my belief that it's better to hold a losing stock too long than to sell a winning one too soon. The winners, as we saw in the case of Netflix, will utterly overwhelm the losers. After all, the most you can lose in a stock is 100%, but my remaining shares in the online streaming company are up by close to 13,500%. So to summarize the points, don't fall into hate with a stock, beware of false narratives, and hold your stocks long term. You'll have some losers, but that's okay. The last thing that he mentions here, and I think this is also worth pointing out, is a mentality that he has. He says, I would like to share a quote from the late Nelson Mandela. In moments of doubt, remember the words, I never lost, I either win or I learn. There are only 2 outcomes in holding stocks. Either you are right and you win, or if you are wrong, then you get to learn. If you frame the situation that way, you will always come out ahead. What's more, I submit that any lesson learned from holding stocks for years, if not decades, will stay with you for life. So that's basically it. Let's try to hold on to stocks longer, not get into false narratives, not be super negative when they start to go down a little bit. And if it ends up doing poorly, that's fine. You can only lose that holding. But if we find some winners that compound for year after year after year, that'll overwhelm the losers. So cool piece of content. I hope you like me sharing this type of stuff. I'll try to do it more often, but that's all for now.